Before we delve into today's comprehensive market analysis, it is essential to remind you, as always, of our legal responsibility. Legal disclaimer: trading foreign exchange and financial products carries an inherent high level of risk and may not be suitable for all investor profiles. The high volatility of the financial markets can lead to significant losses. The content of this video is strictly for educational, informative, and technical purposes. It does not, under any circumstances, constitute financial advice or investment recommendations. You are solely responsible for your financial decisions and the capital you choose to risk in the markets. We strongly advise you to practice in a demo environment before committing real funds. We begin our reading on the euro-dollar pair, placing ourselves in a 15-minute timeframe to observe the short-term structure in detail. After having reached a primary high, labeled as the higher high of the week, the market structure becomes clearly bearish. This shift is characterized by a succession of lower highs and lower lows that indicate strong supply control. At the bottom of this range, we observe how the price is repeatedly testing a specific fair value gap zone. These constant reactions and controlled bounces within the gap indicate that the market is in a complex liquidity-seeking phase, using this imbalance as a key temporary support to consolidate orders before defining its next major directional move. The scenario changes drastically when the definitive breakout of the fair value gap occurs. This phenomenon happens due to a massive injection of institutional supply that completely overwhelms the existing retail demand at that level. After several failed attempts by the bulls to maintain the price, buying interest finally exhausts, allowing the bearish order flow to take absolute control of the price action with high momentum. This aggressive displacement not only invalidates the previous support but also sends us a clear signal: institutions have shifted their bias and are now targeting liquidity targets in much deeper areas of the chart, seeking to rebalance the overall structure. Once we have confirmed the imbalance breakout in 15 minutes, we move up in time frame to the 1-hour chart. The goal of this move is to seek higher technical hierarchy and obtain a macro perspective of the global order flow. We observe that the price ignores the previous support zone to head directly toward a significant 1-hour order block. This timeframe shift is fundamental in our professional methodology, as it confirms that the current movement is not market noise, but an active search for a superior institutional liquidity target. Understanding the higher timeframe narrative is what separates a successful trader from a retail speculator. Descending again to the 15-minute timeframe to observe the refined detail, we identify the formation of what we know as equal lows, located just below our 1-hour order block. In market architecture, these equal lows represent a zone of highly significant concentrated liquidity. This is the exact area where thousands of retail buyer stop-loss orders accumulate, creating a liquidity pool. The interbank algorithm typically seeks these specific levels to sweep those orders, collecting the necessary fuel before interacting with the institutional order block. This confirms the smart money's intent to clear weak hands and retail participants from the market before any reversal. It is vital that as traders we understand that these scenarios are not coincidental. They are meticulously designed by large institutions and central banks to generate the necessary liquidity for their massive positions. While the retail investor perceives equal lows as solid double-bottom support and a safe opportunity to buy, smart money visualizes them as a prime hunting target. By inducing small traders to enter long at these levels with support and resistance logic, institutions ensure they have a massive counterpart of sell orders when the support eventually breaks. This allows them to execute their large contracts efficiently while the small investor is flushed out by their own protection levels. Here we observe the technical trigger we were waiting for in the 15-minute timeframe. The candle marked with the blue arrow executes an aggressive, swift, and calculated sweep of the equal lows, capturing in a matter of minutes all the liquidity that had accumulated during previous trading sessions. It is important to note that this fast and deep movement should not be interpreted as a continuation of the bearish trend. Instead, it is a market clearing or stop run. It is the necessary preliminary step for large institutions to activate their true buy orders at much more favorable prices before initiating a powerful change of direction. Just as we anticipated in our liquidity analysis, immediately after the sweep of the lows, the market experiences a violent and decisive reversal. The price recovers the equal lows area with strong bullish momentum and high volume, which technically confirms that the previous move was a textbook institutional manipulation. Now that the liquidity has been captured and the weak hands are out, the chart traces a direct path toward the upper 1-hour fair value gap. This level now acts as a magnetic target to balance the price following the aggressive expansion we have just witnessed, showing the efficiency of the delivery algorithm. To understand the success of this analysis, it is fundamental to recognize that this entire scenario has unfolded over a full trading week, showing the cycle of accumulation, manipulation, and distribution. For the intraday trader, this is a masterclass in the importance of patience and higher context. Although our final execution is done on 15-minute charts, we must be aware that institutional liquidity engineering often requires entire days to mature. Learning to identify these weekly structures within lower timeframes allows the professional trader to align their decisions with the major market cycle, avoiding getting caught in daily noise and waiting for the exact moment where manipulation transforms into profitable expansion. Moving forward in the session, we observe how the 1-hour fair value gap we previously identified acts decisively once again. After the price recovery from the lows, this technical imbalance begins to function as a resistance zone or a repricing area. This is where the market seeks to rebalance orders after the strong bullish impulse. The precise interaction at this level confirms that gaps originating in higher timeframes maintain their relevance for a long time. They act as critical control points where the price typically reacts, consolidates, or fills orders before deciding on its final structure continuation. The scenario evolves even further, and the 1-hour fair value gap transitions into what we call an IFVG, or inverted fair value gap. This phenomenon occurs when the price pierces the zone with unusual strength and, most importantly, manages to close with the candle body above it. This polarity reversal transforms what was previously an institutional resistance zone into a new high-probability support level. For us as analysts, this shift is the definitive confirmation that buying pressure has completely absorbed all available supply in that price range, validating a new and strong bullish bias for the remainder of the trading day. In the final stage of this market journey, a new fair value gap emerges, originating right after a high-volatility macroeconomic event. This large expansion candle with a wide range leaves behind a significant imbalance that the market immediately validates as solid support. In the world of institutional trading, these gaps generated by fundamental news are zones where institutions re-inject capital to defend their new trend. We clearly see how the market uses this level to stabilize and build a base, confirming that the liquidity injected by the macro event has now become the new operational floor for the entire bullish structure. To conclude today's deep analysis, take a very close look at the area where the original fair value gap and the inverted gap converge. This combination creates an extremely powerful, high-precision confluence zone. Here, the old imbalance and its inverted version work in perfect synchrony to halt any attempt at a price drop, acting as a breaker for the bears. These levels are where the market structure truly consolidates, proving that the price possesses infallible institutional memory. If this detailed content has been of great use to you in better understanding the complex mechanics of smart money, don't forget to subscribe to the channel and hit the like button to support our work. You can also share this tutorial so this information reaches more users interested in professional trading. If you have any technical questions about the concepts explained, I will be happy to answer you in the comments section below or via our official email. Thank you very much for joining us until the end of this session. Stay disciplined, manage your risk, and we will see you in the next analysis.